Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we are discussing over the Banking Regulation Act. Banking Regulation Act. Alright, 1949. Basically we are discussing over it. Alright, and we have covered various provisions enumerated within this act. Okay, so basically in this lecture, we are going to start with another important provision which has been enumerated with this act, and it's very important from the perspective of the competitive exams as well as your in-depth knowledge about the banking system. All right, so as I told you every time, I hope that you revise the previous lecture before you have come for this lecture. It is for your own benefit. All right, so with this note, let's start this lecture. So basically now we are going to talk about the restrictions of business activities provision. Okay, so basically if we talk about the banking, so you can ask me, is the banking is not the business? Is the banking is different? Okay, but you can say that most of the richest businessmen in this world, some of them are owing the banks. All right, so you can say if they are the richest businessmen and they are owing the bank, so it means that banking is also a business. Yes, you are correct. Banking is also a business because, as we know, every business has a single motive called profit making. Okay, for example, suppose you are making 100 units, okay, and rupees 10 is the cost. So you can say total rupees 1000 is the cost incurred in the production. All right, but we know that there is some additional cost added to the product before it sell to the market. All right, there is some additional cost. So 110, so you can say 100 units at 10 at 20, it means that 1 2 3 4, this is the total selling cost of the product. Okay, this is cost of production. Okay, and this is selling cost. All right, so here you can say 20 rupees is basically the additional cost, or we can say the profit. Okay, because rupees 10 is a manufacturing cost incurred. All right, so here we can say the business of producing this 100 rupees is basically doing for earning the profit. Okay, similar thing happens with the bank. All right, suppose if XYZ is the bank, okay, and they are accepting rupees 10 lakhs as a deposit by promising 5% as the interest rate. Okay, it means that the 5% of 10 lakh is rupees 50,000. This is the interest the bank has to give to the depositor who has deposited rupees 10 lakh with the bank. Okay, this is the first case. Second case is that suppose the bank is lending out this 10 lakh as 10% interest. So does the 10% of rupees 10 lakh is 1 lakh. It is the interest will received by the bank. Okay, So here you can see this is the amount received by the bank minus the amount the bank has to give to the customer. So the remaining amount will be rupees 50,000. Okay. This is the additional price incurred during the transaction, and this is basically the bank's income or profit. Okay. So basically you can say bank is also doing a business. Then why we are claiming that the BRA prohibits the banks on the business activities? Okay. So here is the answer. The business does not only mean the buying and selling, it also includes the activities associated with it, the rules and regulations associated with them. Okay, it doesn't mean that you are buying and selling the things. Okay, because the bank is not doing this kind of thing. They are not buying anything, they are not selling anything. Okay, they are not doing these things like this is the bank. They had bought ABC at rupees 50,000. Okay, it is the process of buying. Okay, and then they sold out ABC at rupees 1 lakh. This is the process of selling. So in this transaction, rupees 50,000 incurred as a profit, right? So the bank is not doing such kind of things. They are not buying and selling. That's why they do not properly involved in the business fair. Okay, and that's why the restrictions incurred on them to maintain this balance, or you can say to prevent the bank from indulging into various business activities and get attached to various business plans. Okay, so let's start these restrictions one by one, but I hope that now you have got a little bit picture about what we are going through, okay, and what we are going to cover. All right, so let's start. The first is the restrictions on the business activity. This one, student, here one thing is very, very important thing, and that thing is to remember the sections of the act provision. Okay, it is very, very important, like which section provides for which restrictions. All right, suppose section X, section Y, section Z. There are 3 types of section and they provide A, B, C. So you have to learn them in the same order. You could not make them as section X provide for C, section Y provide for A, section Z provide for B. You could not do this thing because it is totally wrong. Okay, so remember this thing also. All right, so the section A of the Banking Regulation Act prohibits banks from directly or indirectly engaging in the trading or dealing of the goods. However, they are allowed to engage in transactions related to bills of exchange for purposes of discount or trade. Okay, so we have seen that the direct engagement and the indirect engagement is basically prohibited, but they are allowed to do certain specific tasks. So let's understand the concept into deep form. Okay, so the first is the direct engagement. Okay, So you can say banks are not allowed to buy and sell goods like traders or merchants. Okay, purpose, like why they are restricted from doing this thing. The sole purpose is to prevent and protect banks from indulging into commodity market and get threatened by volatile price risk. Okay, so the sole purpose is to prevent and protect banks from indulging into commodity market and get threatened by volatile price risk. For example, suppose this is the XYZ. Okay, the XYZ had received the deposits for rupees 10 lakhs. Okay, and thereafter they buy goods or commodities for these 10 lakh rupees. Okay, in order to sell them at rupees 15 lakhs. Okay, so here are two things. The first is the cost price. It means the price at which the goods and services bought. Okay, and this is the selling price, the price at which the bank is planning to sell out these goods. Okay, so why I'm saying this? The market is a volatile. We know this. Why? Because it's totally depend upon the market forces, and these forces are demand and supply. Okay, so here are two conditions. The conditions are increase in prices or decrease in prices. Okay, so 10 lakh was the cost price and 15 lakhs were the price at which the bank was planning to sell out the product. But suppose if the conditions goes in the negative way, it means that instead of rise in the price falls because of the change in demand and supply. Okay, in such a situation, instead of getting 15 lakhs, the bank has only recovered rupees 8 lakhs because of the volatileness of the commodity market. So here we can say the bank has suffered a rupees 2 lakhs loss. Okay, and we could assume that there were total 10 people at 1 lakh rupees each who deposited their amount. Thereafter, the XYZ got rupees 10 lakh. But in such a situation, when they invested the money in buying of the goods and services, and they only recovered 8 lakhs and suffered 2 lakh rupees. So it means that only 8 people will be able to get their full amount back. But the 2 people will suffer a loss because their amount was invested by the bank into the commodity market and the bank had received nothing. Alright, that's why they are prohibited to indulge into the commodity market. I hope that now you have got a clear-cut idea about the direct engagement and why they are prevented to be indulged in the direct engagement. Got it? Now comes to the second term, which was the indirect engagement. All right. So as per the provision of indirect engagement, banks are not allowed to get interested in any company indulging in buying or selling of goods by purchasing stakes or acquiring partnership in such a company. All right. If we talk about the purpose is to protect bank stability by not allowing them to get attached with risk entity. Okay, so in that engagement, the banks are not allowed to get interested in any company indulging in buying or selling of goods by purchasing stakes or acquiring partnership in such a company. To protect bank stability by not allowing them to get attached with risk entity is the sole purpose. Okay, so now it's a time for an example. Okay, suppose this is the bank called XYZ. All right, this is the XYZ. In the previous example, they were directly buying the goods worth rupees 10 lakhs, or you can say they were directly using their deposit of worth rupees 10 lakhs in buying of the goods. But now in XYZ, instead of buying the goods directly, the XYZ had invested in a company ABC. Okay, so here XYZ is basically the bank and the ABC is basically the company. Okay, so this 10 lakh rupees has been invested in the ABC. Okay, thereafter the ABC invested the money into the commodity market. Okay, and again the same condition happened. It means that prices of commodity goes down. Okay, which means if rupees 10 lakhs were invested, then only rupees 8 lakhs were recovered. All right, it means that the ABC will be only able to return rupees 8 lakhs back to the bank. 10 lakhs were given to them, 8 lakhs were received by the XYZ. This is the condition I was talking about. Okay, now you can say the bank hasn't directly purchased the commodities, but they purchase it through the ABC. That's why it is called the indirect engagement. Okay, the same thing happened, but the banks are not directly engaged in such a cases. All right, that's why the banks are not permitted to do any kind of this thing. It means if ABC involving in a commodity market, then the bank is not allowed to buy the shares or the stakes or acquired any kind of partnership with the ABC. All right. Thereafter, now is the time to talk about the exceptions. Like what are the exceptions to this law? Okay, or you can say on what grounds generally the banks are permitted to indulge in the trading activities. So the first ground is the BOE. which stands for the bills of exchange. Okay. About bills of exchange, we had a detailed discussion in the previous lecture. But right now, I am reminding you once again. Suppose there are two people. This one is the buyer. This one is the seller. Alright. So the buyer purchased a goods worth rupees 2 lakhs. But right now, he do not have a money. So he purchased the goods in the January. And then he promised seller that he will pay the 2 lakhs in the month of, you can say, March. Okay. For this situation, he will make a bill called BP and the seller will receive the bill called BR. Okay. So BP here stands for bills payable. It means that the person who is holding the BP is liable to pay. But the BR stands for bills receivable. It means that the person who is holding the BR is allowed to receive the money. Okay. But now comes the bank in the picture. Alright. Or you can say on behalf of the buyer, the bank will pay rupees 2 lakh to the seller after the maturity in the month of March. Okay. So now you can ask me, how does it a business activity? If you apply your mind calmly and thoroughly, you will get to know that here the buying and selling is involved. That person bought, that person sold. Okay. And here is the credit facility has been provided. Okay. So the buyer will draw the BP on the bank XYZ and thereafter completion of the maturity, the XYZ will pay the amount to the seller. Okay. In such a case, XYZ neither directly nor indirectly indulge in the process. XYZ didn't buy anything, didn't sell anything, they didn't pay anyone to buy or sell anything, but they are providing the banking services. That's why it is called, or you can say that's why they are allowed to perform it. Okay. So it is the first exception. The second exception is the death recovery. Now, what do you mean by it? So basically, it stands for selling out the property, or you can say conceived with the bank for, or you can say conceived with the bank against the loan granted to the customer for recovery of the loan amount. Okay. So let's take an example. Suppose this is a bank called XYZ. Okay. The XYZ had two people. Or basically you can say only having one people called Mr. A. Okay. So Mr. A reached the XYZ to ask for the loan of rupees 10 lakhs. Okay. And we had discussed that the bank has to submit something equivalent to the amount provided to the customer. It means that if the 10 lakh rupees loan has been taken out by Mr. A, so something of worth rupees 10 lakhs must be submitted with the XYZ as the collateral security. Okay, which means that the bank could sold out the thing if the amount hasn't been paid to them. Alright, so suppose the loan was granted from the time period of January to March, or you can say January to December. Okay. But after the completion of the time period, still Mr. A is not able to pay the amount back to the XYZ. And after performing all the, you can say, protocols regarding the loan recovery, lastly option left with the XYZ is to sell out the collateral. Okay. So here this activity is called out selling activity. All right. And most of you will say this is the selling activity. It means that what? It is a business activity. But here it is accepted to the provision. Why? Because now the XYZ is selling out not for earning the profit, but for recovering the loan. Okay. So remember this thing. In the debt recovery, the bank could sold out the collateral security submitted with the bank against the loan amount which has been granted to the customer. Okay. Now, the third exception is the ancillary services. Okay. Ancillary services is basically the unclaimed properties which had been submitted to the banks once and now no one is claiming them. Okay. In such a cases, the bank could sold out these properties. For example, this is the XYZ. Okay. The XYZ has 10 Maruti cars which were once submitted to XYZ as a security or whatever you can say. Okay. But even after many years, no one came to the XYZ to claim these cars. Alright. So in such a case, the XYZ could sold out these 10 cars to liquidate the asset. It means that suppose if these Maruti cars were worth rupees 20 lakhs. Okay. So now they are in the physical form. But after selling them, they will in the form of cash or liquidation. Okay. So in such a cases, the bank could perform the banking activity of buying or selling. All right. So students, this is the first provision that we had discussed. All right. Direct engagement, the example. Okay. Thereafter the indirect engagement, the proper example. Thereafter the exceptions, like the first one is the bills of exchange with example, debt recovery with example, and the ancillary services with example. All right. So in this lecture, we have done a first provision. In the next lecture, we will start with another provision. All right. Till then, just revise the facts and figures we have discussed in this lecture and be ready for the another lecture. Okay. With this note, let's end this lecture and thank you.